up, and away as the economy starts to come back, bringing jobs with it, and the U.S. sets new records in COVID vaccines. What's not to like? This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard.
I'd have liked to see a bolder, bigger vision on infrastructure.
And Afsaneh Beschloss of RockCreek. Howard Marks of Oaktree Capital. Josh Bolten of the Business Roundtable.
We're against the increases in corporate taxes, strongly against it.
Marty Chavez of 6th Street Partners.
It's a matter of urgency for the U.S. dollar to digitize.
And Mona Mahajan of Allianz Global Investors. There wasn't a lot for investors to find fault with this week. More economic numbers pointed to a rapidly approaching recovery.
It's actual progress. It's not projected progress. It's hard numbers on the labor market and on prices.
The U.S. stepped up its already brisk pace of vaccinations, even as infections picked up in the Northeast. And California set June 15 as the goal for its fully reopening its economy. But wait, there's more. As President Biden presses forward with plans to invest another $2.25 trillion in the American economy for what he calls infrastructure, and critics say goes well beyond infrastructure alone.
The problem with this infrastructure package, though, David, is that it's less than 25% of it goes to infrastructure.
But whatever you call it, the president says we need to raise taxes on corporations to pay for it all.
President Biden's proposals announced last week call for bold domestic action, including to raise the U.S. minimum tax rate.
Overall, markets kept their optimistic outlook, with the S&P staying in record territory over 4,000, and the 10-year yield resumed its upward march after a jump in producer price data added fuel to inflation concerns. So, in an investment world where so much seems to be going so right, what do you do if you're looking for some distress somewhere? That's the question we put to acclaimed distressed investor and author Howard Marks of Oaktree Capital Management.
One answer is that we're active providing solutions to companies that want to recapitalize their balance sheet, change their debt structure in some way, or just add additional liquidity, not distress situations, but there are cases where there's an appetite for credit and the market doesn't make it available. We are active around the globe, and there is more to do in Asia and in Europe than there is in the United States. I think we distinguish ourselves as investors by what we do when our strategy is not in great favor. Every strategy goes in and out of favor, and this is the time to try to be resourceful and yet maintain our standards. It's very challenging.
Howard, it strikes me that one of the things that's different from anything I think I've ever seen, maybe any of us have ever seen, is the degree to which the government, both on fiscal and on monetary policy, is intervening in the marketplace. Is that sort of a dampener on your business in the sense that, for example, when it comes to distressed debt, you've got a lot of zombie companies. I think it's like 19% of the publicly traded companies in the United States right now are zombie companies, do not generate enough cash to pay off their debt. Does that really make it more difficult for somebody like Oaktree?
That's in short, that's the kind of situation that presents opportunities to us. If companies have no problems, no exigencies, then the distressed investor doesn't have any problem, anything to do. So we take companies which are in extremis or producing bad news, where the future doesn't look so great, and if we can buy those securities at the right price, which means a price that overestimates the problems, that's how you make money as an investor. So we don't shy away from difficulties.
But isn't there a price support under those companies, if I can put it that way, because essentially money's free. They can borrow more money, even though they're losing money. They're not generating enough cash, again, to service their debt. Doesn't that actually make it more difficult to get the right price for you?
Yes, it does. Yes, it does. I mean, the right price for us is to be able to buy things for less than they're worth. That's our goal. We need cooperation from somebody who's willing to sell things for less than they're worth. And usually you get that when the asset holders feel urgency to sell, and when there is no support, and when yesterday's decline is viewed as merely a foreshadowing of a further decline. That's when you get to buy things at reasonable prices. And today, those things are generally not the case.
What about currency? Where are you on the U.S. dollar? How much does that factor into your decisions? Because there are a lot of people thinking.
We don't take an opinion on currency. One of the 6 tenets of Oaktree's investment philosophy is that our decisions are not guided by macro forecasts.
So you don't worry about long-term weakness of the dollar?
Well, I worry about it for other reasons, not in saying, well, will I invest in this thing which is in pounds or rupees or renminbi or pesos or something like that, and not tactically like that. But, I mean, it's a concern the way the U.S. is behaving vis-a-vis the dollar. But on the other hand, not clear what one does about it.
Howard, there's a lot of discussion, as you know, debate even, about the possibility of inflation, as we're about to add. We're in the process of adding $1.9 trillion on the rescue package, and now we're talking about another $2 trillion potentially from infrastructure plan. How concerned are you about inflation and therefore increased rates?
I am concerned. I'm not an economist. I don't trust in economic forecasts. But I do think that, look, last year we added $6 or $7 trillion to the debt. This year we're on pace to probably do 5 or 4 or something like that, and the next year. Now the relief package will add substantially. The infrastructure package is less of a worry because those trillions are spread out over at least a decade. So they're only 200 billion a week. That's all. By the way, last year it was the year the word trillion became in common use. I don't think we've used it much before that. But when a country adds that much to its debt and prints that much money and has to borrow that much money to cover the debt and refinance the debt, cover the interest on the debt and the deficit, I think it historically the knee-jerk reaction would be to say, well, that cheapens the dollar because there will be too many in circulation, and we'll have to try too hard to get people to finance our deficits. Now the Fed claims not to worry about that, and I hope they're right. We'll see. They claim that the slow economy is more of a worry than a too fast economy, which would bring on inflation. Let's hope they're right. But when you, as you said earlier in the segment, we've never seen stimulus like we have at this time, and I always say that if you've never seen something happen before, you can't say how it's going to end.
And one of the things you're known for, certainly I read all your notes about, are really figuring out what you do know and what you can't know, and not trying to guess at the things you can't know. We haven't been in this territory before. A lot of people seem to be assuming maybe the debt and deficit doesn't matter anymore because the interest rates are so low. We've heard Janet Yellen just this week say, you know what, these are long-term trends. They keep it down, and so there is really no danger of inflation. Should we be worried about that analysis? Do you think that the debt and deficit still matter?
I find it, let me take the opposite side. I find it hard to believe they don't. I mean, it's like saying that we have a credit card. The United States has a credit card with an infinite balance capability, and you never have to pay it off. It sounds too good to be true. And if somebody offered me that credit card, I would look for the catch. That's all I'm saying.
That was Howard Marks, co-founder and co-chairman of Oaktree Capital Management. Coming up, we convene our Wall Street Week Roundtable of Afsaneh Beschloss from RockCreek and Mona Mahajan of Allianz to find out where the investment opportunities are in this land of plenty.
We're going to have a more growth-oriented kind of impact on the overall economy.
We do see a continuation of the reopening trade.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Everything is coming up roses for investors, it appears, at least this week. The question is, where are the opportunities, and for that matter, where are the threats in all of this? And to answer that question, we are convening our very special Wall Street Week roundtable right now of Afsaneh Beschloss. She is the founder and CEO of RockCreek, and Mona Mahajan. She is the U.S. investment strategist for Allianz. Thank you both for being here. Welcome back. Mona, let me start with you. I talk about opportunities and threats. I used to do a SWOT analysis, strengths, weaknesses, opportunities, threats in business plans. Take the opportunities and threats for a U.S. investor right now in this market, given the fact that everything looks pretty good.
Yeah, absolutely. Look, it's been a phenomenal market, really, in many ways across asset classes. In our view, that's been driven by two key themes this year. The first theme is clearly this rotation we're seeing, at least in the equity space, from growth into the more value-oriented sectors, at least on a year-to-date basis. And really since November of last year, keep in mind, last November, we saw presidential elections, we saw the approval of our first vaccines. And when you look at sectors like energy, financials, industrials, up nearly 70%, 40%, and 30% plus since that time. The second theme, of course, is this rise in rates. The 10-year has gone from 0.91, now 165, also supportive of some of those value sectors and putting a little bit pressure on the growth sectors. For us, the opportunity really is we do see a continuation of the reopening trade. We think there's at least one last leg to go. And that really, the highest conviction areas that we like there do include those that are levered to higher rates. We think, yields could continue to grind higher, maybe a little bit choppy now, but we see a two-handle on the 10-year at some point. In that environment, we think financials continue to do well. Certainly, yield curve plays continue to do well, such as steepeners. The reopening, the true reopening of the U.S. economy, we think those, the areas that do well in that environment are those that are levered to better earnings growth, like leisure, travel, think your true reopening sectors. And the final bucket we put in that, the opportunities, is really those that are levered to the new policy agenda we're seeing. So parts of the infrastructure market, parts of 5G and cybersecurity that are being lumped into infrastructure now. Now, just quickly on the threats, as we are heading to the second half of this year, we certainly are seeing some headwinds emerge. First and foremost, we will at some point hit peak reopening growth here in the U.S., probably in 2Q or 3Q of this year. We will have, the highest growth rates we've seen probably in over a decade. Secondly, we are seeing, as we noted earlier, yields continue to grind higher, driven by, of course, reopening, but also potentially inflation. And, thirdly, I think we are looking at a Fed that at some point, David, will have to come off of this crisis level accommodation. They said in the last press conference, it's when they see it in the data, not in the forecast. Well, that data is certainly going to come to fruition in the next couple of quarters. So keep in mind, we've had a great first half thus far. We might see another leg higher in this value rotation, but at some point we will consolidate those gains. Maybe it's seasonal, maybe it's sell in May and go away, maybe not in May this year, but a little bit further out. But just keep in mind those headwinds in the second half of this year may start to emerge.
Afsaneh, Mona really took us right into your backyard, or at least part of your backyard, when she talked about investments leveraged to policy, because you for a long time have talked about climate and green investing, Afsaneh. You've been a champion of that. We certainly heard about the infrastructure plan, $2.25 trillion, a lot of it directed toward climate issues. That's an opportunity. At the same time, do you need to be a bit of a stock picker, if you can say that, within that realm? Not all climate projects are created equal, I assume.
You're absolutely right, David, and I very much agree with everything Mona said. I think added to what she said, on the infrastructure side that you just mentioned, whether it ends up being 2.25 or 1.9 or 1.6 or somewhere in between, those numbers are quite huge. And even if they get spent, some of them more quickly, some of them over time, they're going to have a more growth-oriented kind of impact on the overall economy. And what we're seeing as we're sitting here today is unbelievable amount of investments that are going into that intersection of innovation with EV, innovation with tech, with medicine, innovation with some of the other trends that we've talked about, but in particular, climate-related investments. So I think all of them will be also impacting markets in a very positive way, sort of looking longer term. I agree with Mona, though, that we will have some short-term corrections because interest rates are historically low. Even if we had the kind of bond markets, particularly at the long end that we've had this year, we have been historically at a very, very low level of interest rate, and people have got very used to that. Those of us who've been around a few cycles know that it will not last like this, and there will be some sort of impact as inflation picks up even for a short time and goes back to lower levels over longer term.
Mona, one of the things that we're reading about now is perhaps some risk coming from the divergence we're seeing. The United States is really going ahead full steam with vaccinations. China, if anything, doing better than we are on dealing with the COVID-19. Europe, not so much, and goodness knows parts of the lower and middle income countries are lagging behind, Mona. Is that simply opportunity for U.S. investors, or is there also some risk if the U.S. gets too far ahead of the rest of the world?
Yeah, absolutely. You know, one of the themes that we're seeing emerge again this year is this return to U.S., what we're calling exceptionalism. Certainly, we have been ahead of Europe, as you noted, in terms of the vaccine rollout, and really setting up nicely for a strong set of summer months ahead of us. We're seeing this play out in the markets as well. The U.S. dollar, many expected to come into the year continuing to be weak. In fact, we've seen stabilization and even an upward trend. The dollar index is now up about 3% year to date. Similarly, in equity indices, you know, the S&P is now back at the top of the pack. Clearly, there could be a catch-up trade, and it's one thing we're thinking about now, especially as the U.S. markets have run. There could be a catch-up trade from Europe to be had here. You know, if they are lagging just a few months behind us in this vaccine rollout, we could see a real reopening of their economies in maybe another quarter or two.
Afsaneh, Mona says that we may be a few months ahead of Europe. We're a lot more than that when it comes to low and middle income countries. And that's true both with respect to vaccines and also with respect to the economies right now. We've had the IMF meetings. I know you've participated in them this week. A big topic of conversation. Give us a sense from your point of view of where we are in some of the more struggling nations around the world.
In some emerging markets, particularly the low income group, more than 20 years of growth that is potentially lost. And a lot of the numbers we're seeing, let's say the IMF, I think the IMF has really jumped ahead. And we heard about the 650 billion SDR package that was just agreed to, plus another 30 billion that IMF has put out for the pandemic window. Those are huge numbers, but we have to realize that, let's say out of that 650 billion, only 21 billion will go to the lowest income of those countries. And as we just said, in Africa, probably even by the end of this year, less than 5% of the population will be vaccinated. So putting this all together, as Janet Yellen said, I think it was this week, economic policy and COVID policy really go hand in hand.
Okay, thank you so very much to our special Wall Street Week roundtable of Afsaneh Beschloss of RockCreek and Mona Mahajan of Allianz. Coming up, investing in infrastructure is one thing, but raising corporate taxes may be something else altogether. We talk with Josh Bolten, president of the Business Roundtable, about the difference.
If the Biden increases go through, we will once again be the worst in the industrialized world.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. President Biden spent a good part of the week pushing his American Jobs Plan, seeking to invest $2.25 trillion in infrastructure and arguing with Republicans about what is and what is not, quote, infrastructure. American business stands to benefit from some much needed support. But is it willing to help pay for it through increased taxes? That's the question we put to Josh Bolten, president and CEO of the Business Roundtable.
We're against the increases in corporate taxes in the administration's proposal, strongly against it. It's a massive tax increase on U.S. business, which is really damaging, not just to the shareholders of all of those businesses, but to the employees and customers as well, who bear a large portion of the burden of a tax increase. And most important, the massive kinds of tax increases that the Biden proposal would impose over the next 15 years on U.S. business would make us once again the least competitive in the developed world. And especially as we're coming out of the pandemic. But at no time should we be undermining the competitiveness of U.S. business, whether it's over the course of the next year, which is a ridiculous time to do this, or even beyond. We need to be competitive with China and all the other powerful economies of the globe, and we can't do it if we've got the highest tax rate.
At the same time, if you look at the percentage of GDP in terms of revenues from corporate taxes, they have gone down for the last many years. They're down like 1% of GDP, which is below an awful lot of OECD countries right now. Does that give us some indication maybe we are overall under-taxing corporations compared to the rest of the world?
No, we're not. I mean, if you look at the average of the industrialized world, the OECD average, the current rate is about 23.5%. We are now, without the Biden tax increases, I mean, today, we are at 25.9%. So we are 2.5% already off of the average in the industrialized world. And if the Biden increases go through, we will once again be the worst in the industrialized world, which is a huge mistake for the competitiveness of this economy at this time especially, but at any time.
So I just want to be clear, your position at least right now is it's not a matter of it's too high to go to 28. You wouldn't go up for 21 at all.
No, and by the way, the 21 rate has proved to be very successful in the years that followed the 2017 tax reform. The following years, the economic growth was good, and here's the most important part. Employment was good. Employment fell to 50-year lows in the aftermath of the 2017 tax increase. And in particular, we got record low levels of unemployment among the Black, Hispanic communities and among workers without college degrees. That's what we ought to be striving for right now, and a big tax increase takes us in the wrong direction.
So you're in Washington. You're a master of Washington. You were the chief of staff to President George W. Bush. You know that town well. Ultimately, it gets back to politics. And there's polling out that suggests that a majority, narrow, 53% of Americans actually favor a big infrastructure supported by corporate tax increases. And there are numbers that indicate that actually the tax cuts did help, but not that much. If you take away housing and private sector investor, you actually get to 4% from 3.8%. What about the politics of it? Isn't this something that Americans might actually be in favor of, raising taxes on corporations?
Yeah, I mean, it's easy to demonize big corporations if you neglect the fact that corporations don't pay taxes. The people who pay the taxes are the shareholders, the employees, and the customers of those corporations. And a lot of those shareholders are ordinary Americans through their 401k plans. So I think if you explain all of that to Americans and you explain to them that this tax increase will make it substantially harder for the U.S. to compete, especially against China, I think you get different results from those polls. Everybody supports infrastructure spending, and they properly should, but paying because it makes us more competitive. Paying for it by making us less competitive is just the wrong way to go.
Thanks to Josh Bolten of the Business Roundtable. Coming up, you may think you know what cryptocurrency is all about, but Marty Chavez of Sixth Street Partners says it's not necessarily what you think it is.
There's an opportunity both for wholesale and retail to continue modernizing the payment system.
This is Wall Street Week on Bloomberg. Wall Street, central banks, and retail investors have one thing in common: their growing interest in cryptocurrencies. According to CoinShares, inflows into crypto funds and products hit a record $4.5 billion in the first quarter of this year.
There's $140 trillion of U.S. wealth, $400 trillion of global wealth. So we're now up to half a percent of global wealth is in crypto, and that's growing. I think it'll be 1% by the end of the year.
Bitcoin gets the most attention among its crypto peers. but critics of digital currencies raise concerns about their structure and their volatility.
I don't completely buy the whole thing. You're essentially saying that we're going to create a store of value and a medium of exchange around something that only exists inside of a computer somewhere.
Bitcoin is not having any income, doesn't have any users, doesn't have liquidity services, doesn't have a utility. What's the intrinsic value of it? It's just a self-fulfilling bubble.
Beyond Bitcoin, it's the underlying technology of blockchain that is attracting investor interest. According to CB Insights, startups focusing on blockchain raised about $2.5 billion in just the first quarter of this year, outpacing the amount raised in all of 2020.
What it's really doing is it's building an infrastructure to actually transact on.
Central banks are also feeling the pressure to create their own central bank digital currencies. A recent survey by the Bank for International Settlements found that 86% of central banks are currently engaged, up from 65% in 2017.
What the central bank is essentially trying to do right now is a very mild version of if you can't beat them, join them. They're almost trying to disintermediate the disintermediators.
The motivation for central banks has been partly to guard against the risk of financial exclusion or digital dollarization if payments shift to privately controlled alternatives.
I do wonder whether, at this point, Bitcoin should also be thought in part as a Chinese financial weapon against the U.S., where it threatens fiat money, but it especially threatens the U.S. dollar.
Marty Chavez is someone who really knows his way around blockchain and distributed ledgers. He's been part of Silicon Valley startups. He's taught the course at Stanford. He's been the CIO and then the chief financial officer of Goldman Sachs. And now he's a senior advisor at Sixth Street Partners. And he says that digital currencies may ultimately hold the key to global reserve currency dominance.
I still don't know what form exactly central bank digital currencies will take. It's not 100% clear at all that they need to be on a blockchain. They certainly need to be highly distributed, privacy protecting, and fault tolerant. There's a geopolitical overlay. So we've seen some sovereigns, such as China, very aggressively introducing a digital currency. And I'm not privy to their conversations, but sure, I would love to have international trade priced in that currency as opposed to dollars. On the other hand, everybody's going to be really skeptical that maybe the surveillance of another state or sovereign attaches to someone's use of their digital currency. And so privacy protection while achieving anti-money laundering and know your client, these are all very, very difficult balances. But I'll go back to something I said 10 years ago when I was talking to one of the early Bitcoin CEOs, and I think it's related to where you started the conversation. I said 10 years ago, I am highly confident that the Fed will continue the digitization of the US dollar, and one day it will be a digitally native asset, effectively a cryptocurrency. And he said that will never happen. And I said, well, I don't use never, and I'm sure it will happen. And there's this divide, East Coast, West Coast, this sort of a little bit of thinking in Silicon Valley that those people in New York and DC will never figure it out. They will figure it out.
Well, one of the things that I'm curious about is we tend to think of cryptocurrency, we all think about Bitcoin because it got there first and has the biggest name, as sort of a way of speculating and developing assets and value and things like that. There's another possible use here, as I understand it, which is to really redo our payment system. We actually had Chair Powell say, one of the things we found in COVID-19 was how vulnerable our payment system is. We have the SWIFT payment system, which is really pretty long in the tooth at this point. Is there a potential in the near future to basically have cryptocurrency, digital currency, whatever we call it, replace our payment system?
Yes, there absolutely is. And you can see the foreshadowing of that. I know you were watching closely during the congressional deliberations in the depths of the pandemic, and you might have remembered one version, a House version of the early stimulus bill, directed the Federal Reserve to create a digital US dollar and distribute them to Americans. And I remember thinking, that's a really great idea. Maybe I'll just sit down and code that up over the weekend. Right? The point is that is a huge project. And there's an opportunity both for wholesale and retail to continue modernizing the payment system. We've been electronified and digitized for a long time. Your bank account is an entirely digital construct. The question is, do we want it to be account-based? Do we want it to be like the paper dollar bills we have, except it's a digital token? These are all topics that are very actively being debated right now.
And what role do we want the regulators to have, the Federal Reserve or other central banks to have or not? Because we have digital dollars, I guess we could call them right now, because there are cryptocurrencies that are tied, specifically like Tether, to the U.S. dollar. So those are like digital dollars. That's different from the central bank, though, actually creating these. Is that right?
Absolutely. I start off old school a little bit, even though I grew up in Silicon Valley, as an extreme skeptic of stable coins. To me, stable coins are stable until they're not, just like any currency peg that ever existed. I remember when the Argentine peso was pegged to the dollar, and it was great. You could choose at the ATM, and it depended on a currency board doing what they said they were going to do to keep that one for one. And that's the challenge with all of these stable coins. And so I think there is a necessity, absolutely, for there really to be a digital dollar, meaning it is a claim on the United States of America and simultaneously on the Federal Reserve, not something that's close to that. I think it is inevitable that we will get there. And I would not dismiss the power of the sovereign, right? Go back and read your political science, right? The Leviathan, the sovereign can demand that you pay your taxes in the currency that it issues. And that's what breaks the circularity of fiat currency.
Yeah, look at Henry VIII or Elizabeth I. Yeah, it didn't work very well when they went up against the sovereign. But you said there's a necessity. Is there an urgency? You mentioned China before, and I have read that China is really pressing hard. They've essentially, I think, eliminated the ability for private parties to buy Bitcoin in China, but they are pressing hard on a central bank digital currency.
Yes.
Does that put pressure on us to compete with China on that?
Well, there have been a lot of conversations on this topic. And look, I will just give you a point of view. And as I said, I'm obviously not privy to the conversations inside the Chinese government. But if I were thinking about it from their perspective, and I assume they are thinking of all these things, I'd say, okay, we have a closed capital account. On the other hand, what if international trade could all be priced in yuan and everything exchanged frictionless in exchange for digital yuan? Maybe I would open up the capital account. Oh, well, then will people actually hold the digital yuan? Well, I'd have to get them really comfortable on privacy, and it can't just be trust us. It would have to be mathematically, cryptographically guaranteed privacy. And so you can be absolutely sure that these conversations are happening.
That was Marty Chavez of Sixth Street Partners. Coming up, a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It is time now for a look at what's coming up in the week ahead on Global Wall Street.
David, the global chip shortage has commanded attention. Now, the world's biggest chip maker, TSMC, has been at the front line of the supply bottlenecks. Capacity has been running at full tilt, so TSMC's expansion plans, if any, will be closely watched when earnings are released on April 15th. On the eco calendar, China's first quarter GDP report is the headline. Consumption will be a key focus area. Plus, we have policy decisions from South Korea and New Zealand, both likely to hold. And from India, Monday's data is expected to show a pickup in consumer prices. The RBI is staying accommodative in the face of inflation pressures and announced instead a bond buying program that kicks off next week. Danny?
Thanks, Sophie. On Monday, the UK is finally back in business. We have shops reopening as well as outdoor dining. Over the week, we'll also keep a close eye on woes with the AstraZeneca vaccine, with more European countries recommending it not be used on younger populations for fear of rare blood clots. Romaine?
Thank you, Danny. An important White House summit about the global chip shortage is taking place on Monday. U.S. national security and economic advisors from the Biden administration They're meeting with industry executives about ways to address semiconductor supply constraints. Tuesday brings us the latest economic data on consumer inflation. It's a report that will be heavily scrutinized as the most recent release of wholesale prices surprised to the upside. And midweek, the U.S. earnings season starts back up. J.P. Morgan, Wells Fargo, and Goldman Sachs reporting their performance on Wednesday. Bank of America, Citigroup, Delta, and United Health report on Thursday. And Morgan Stanley and Kansas City Southern, they're set to disclose their results on Friday. David?
Thanks to Sophie, Danny, and Romaine. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We're going to complete the week, as we do every week, with our special contributor, Larry Summers of Harvard. Larry, welcome back. Great to have you with us. I think a lot of the week was given over to infrastructure, whatever that means. President Biden has his $2.25 trillion plan. A lot of semantics about what was included, what's not included. And I want you to address that as an economist. How important is it to get clear about what infrastructure is? Because President Biden said it's bridges and tunnels. Sure, it's also broadband internet. But then he said it's anything that enhances the life of the middle class. That seemed a little broad.
Look, what's most important is that we make the investments as a country that we need to, not what we call them. We need better bridges. We need to expand broadband. We need to build more schools. We need to make sure there's adequate housing for low-income families. The semantics really aren't so important. Frankly, I'd have liked to see more traditional infrastructure in this package because I think we're decades behind, and I'm not sure this is big enough to bring us to the forefront, and I'm not sure there's enough really major, large-scale projects. There's $80 billion to help Amtrak's operating budget, but there are no major new systems. So I'd have liked to see a bolder, bigger vision on infrastructure. And the other thing I'd have liked to see, David, is more discipline. Discipline to make sure we procure in a cost-effective way. God knows the First Avenue subway in New York costs 7 times as much per mile as the subway in Paris, and they're not especially efficient in Paris. I'd have liked to see more speed in implementation. I've talked many times about a bridge near my office at Harvard, a 300-foot bridge that took them 5.5 years to repair. Well, you know, Julius Caesar built much longer bridges in 9 days. And I'd have liked to see rigorous analysis, and we may get that analysis, that this spending's going to be incremental. For example, there's no question we should have electric charging stations across America and electric cars, but we built gas stations without the government ever paying. Does the government really need to pay as much as is contained in this bill to get electric charging stations across the country? So I think Democrats are completely right on the need for much more resources, but I think some Republicans have a point when they emphasize efficiency, when they emphasize alacrity, and when they emphasize discipline in setting the functions. But this is hugely important for our economy. This is certainly worth, in many of the areas, substantially more government borrowing.
So it's hugely important to get the money to do the investment, but it's almost as important to make sure that it gets done right, or as close to right as possible. You've worked at the top levels of government. Do we need to rethink the way our government really administers itself in this sense? When was the last time the U.S. government spent $2.25 trillion and did it the right way? Can we have a rigorous system for return on investment, which is what you do in a corporation, to say, okay, we'll invest this money, but this is what we expect back?
This should be a huge priority in the design of all of this. But of course, more extensive review can be the enemy of more alacrity, but more speed. But I think we, with the right kind of administration, can do much better. Take an area like high density power lines. The issue there is not lack of money, it's lack of regulatory approval. And we got to figure out how to get the states cooperating so each state doesn't hold up all the other states in that area. I'd like to see President Biden talking more about the importance of doing it well and acknowledging more some of the past failures. On the other hand, I think there are some who seize on the semantic issues, who seize on some of the things that weren't great, who give the Pentagon a complete pass on every failed weapons system. But if some mass transit system in an urban area doesn't work exactly right on schedule or overruns its cost, go into a state of hysteria. And that's wrong. And so I'd say to my friends in the Republican side, let's have some symmetry in what you're prepared to do with respect to military procurement and what you're insisting on in these areas.
Larry, another big story this week were the IMF meetings, the spring meetings of the IMF, and it really underscored something we're watching, which is increasing divergence around the world, both in terms of the vaccination programs as well as in the economic growth. We see it even between the United States and Europe at this point, but then when you go to the low and middle income countries, it is quite stark, both on the vaccination rate and also the economy. What can and should be done about this? This is something you've been talking about for well over a year now.
Look, what we understand better today than we did 6 months ago is that this is going to be heavily about the ways in which the virus does or does not evolve. If it stops evolving, we're going to get this problem completely under control. If it keeps evolving, it's going to become an endemic problem. And evolution happens in proportion to how much the virus is all over the world. And that means uncontrolled COVID anywhere is a big threat to people everywhere. And if you're living in Pittsburgh, you've got almost as much risk from uncontrolled COVID in Lagos as you do from COVID in Philadelphia, because a new strain will get everywhere within 3 or 4 months. And that makes it absolutely essential that we have a global vaccine effort, a global testing effort, and this is a critical point that I've been working on. We're going to have one of these things every decade or so. We're going to have a threat like this every decade or so. And we need an infrastructure to make sure that we're constantly watching and ready to stop it at its source at the beginning. And that's what we didn't have this time. You know, the economist term for it is a global public good. We've got to support the international financial institutions, especially in providing the resources that do what's necessary. My sense is that with the necessary annual costs for prevention in the $10 billion range, or maybe even less, and the cost of this in the trillions of dollars, that the single highest return investment that can be made globally is in infrastructure to prevent these from recurring. And the second highest investment we can make is in getting this thing under control.
Okay, let's wrap this up with a quick line. A lightning quick round of Summer says, start off with central bank digital currencies. Much the vogue right now. We've learned that most central banks are working on a digital currency. 5 years from now, will the Federal Reserve have its own digital currency?
I doubt it. It'll have a bunch of stuff with digital accounts, but no real digital currency.
We also heard this week from Secretary of Treasury Yellen, about coordinating with OECD on a corporate minimum tax internationally. Is that going to happen within the next year?
Bravo, and it's going to be as or more important than the next trade agreement we reach with some other country. This is the international integration issue of this moment.
For some of us living in New York, we got hit with a big new tax. If you made a lot of money in New York, you're going to pay a lot more taxes here. There's a lot of concern about that, individual stories about people moving away. But in the larger sense, do you think this might affect the economy of New York State?
You deserve to pay more taxes. It should happen. But New York City and New York State can't do it alone without substantial consequences in this environment, and I am very fearful that, particularly without federal deductibility, this is going to do a lot of damage to New York's tax base and set off a downward spiral.
And finally, Larry, the big story from last week with Archegos, the sort of implosion of Archegos. Should we expect within the near future more regulation of family offices?
I wouldn't be surprised, but even more, I'd expect more regulation of prime broker lending.
Okay, many, many thanks to our special contributor here at Wall Street Week. He is Larry Summers of Harvard. Finally, one more thought. Getting more bees with honey than with vinegar, especially if they're rich bees. This week saw a lot of talk about taxing the rich in the United States, whether they're companies.
That at least 55 of our largest corporations use the various loopholes to pay zero federal income tax in 2020.
Or they are people.
Moving capital gains taxes up is a big deal, right? That, in essence, is a wealth tax.
New York State is doing more than just talking about it. After Governor Cuomo last year pleaded with the rich to stay in New York.
I say, you got to come back. When are you coming back? We'll go to dinner. I'll buy you a drink. Come over, I'll cook.
This week, the New York governor agreed to a budget slapping big new taxes on those making over $1 million. Taxes that could raise the marginal rate for the richest New Yorkers up over 52%. Only time is going to tell whether the state's 90 billionaires or 30,000 millionaires vote with their feet because of all these new taxes. But we are already seeing what using a bit of honey instead may mean, as the Chinese government plans new tax breaks on the wealthy in Hong Kong, seeking to make up for all those violent demonstrations and the political crackdown, with the result that investment managers have set up more than 100 new companies in recent months. And banks like Goldman Sachs, Citigroup, Bank of America, and Morgan Stanley are ramping up their staffing over there. None of which is to say that those of us who have benefited from the boom markets shouldn't pay our fair share, much less that we want to trade off civil liberties for tax breaks. But we do have to hope that the people making decisions keep in mind that pesky law of unintended consequences. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.